Thank you, Cindy, and welcome to you all. Excited to have a conversation today. We're eager to have this be a dynamic discussion, so we will leave plenty of time for Q&A at the end. But along the way, if we say something that doesn't make any sense and you want to interrupt, please feel free to go ahead and do it. So I head up our global sports business at Goldman Sachs. In the last about 18 months or so ago, we set this group up. I'll talk about it in a little bit, but we're really thinking about sports as an asset class. And think it's truly a global asset class, and it's certainly a place where there has been enormous focus, interest, capital, innovation taking place across the entire sector. Josh, would love to hear from you. Just talk a little bit about Sixth Street. You've been it's one of the largest and fastest growing alternative asset managers, but certainly been among the most innovative, if not the most innovative, in terms of allocating capital into sports. And so maybe talk a little bit about Sixth Street, role in sports, and what you do.
Be my pleasure. Great to see all of you. Thanks for coming out and spending some time with us this morning, and looking forward to the discussion. Sixth Street, interestingly, and this will, I think, lead a little bit into what you're talking about with Goldman. Actually, the genesis of Sixth Street came out of a group of Goldman Sachs folks who saw an opportunity in the global financial crisis for capital that didn't fit within conventional definitions. So for a lot of you folks, private equity is a term that gets thrown around a lot. It's actually fairly specific within a larger universe of all the private capital that exists in the world and is being continually deployed in any number of industries. And private equity, which is where it started with the big buyout firms, is it's sort of a diminishing percentage. Though it's growing, it's a diminishing percentage of the capital being created. And the opportunity that Sixth Street was built around was to sort of go where the conventional definitions don't fit. So offer bespoke financings to companies that sort of didn't exactly need what the market typically offered, but wanted somebody to create a solution for them. So what we pride ourselves on are very specialized and sort of situation-specific structures that may not fit within the conventional definition of equity, may not fit within the conventional definition of debt, or even things like asset-backed financing, which we don't need to get into today. And so that was really, what we built, what we built the firm around, and it was a uniquely, I think, good fit for sports for reasons that we'll talk about, I think, over the course of the time together. But really because sports is growing so quickly as an industry, and there are structural reasons why it just needs to be financed differently than other industries. Some of those are at the league level. Some of those are sort of specific to the nature of the businesses that people who own teams and own leagues, the constraints on them and the way they need to operate their businesses. But what we've really tried to do is go everywhere that the existing solution set wasn't sort of optimal. And that's sort of taken us from starting as a bunch of runaways from Goldman to $120 billion in assets under management and a pretty global platform. And thanks to great partners like Dave, we've been pretty active around sports, and I hope we'll get a chance to talk to you about that. But we would not be here without Goldman and the sort of platform that is. And you guys do some pretty cool stuff in sports as well.
Thanks, Josh, for that. So I want to spend 2 minutes just talking about how we think about the business in an asset class. So I sit in investment banking, so think traditional, more IPOs, debt, equity, hedging, activism, right, hostile takeovers, all that kind of stuff. Within the sports context, we've really separated our business into 3 different verticals. Teams and leagues, and so you certainly understand what that is, and there's been a lot going on. I would say the team sales, the minority stake sales in teams, seem to suck a lot of the oxygen out of the media atmosphere. We can come back and talk about your whether it was an
We're
announcement yesterday or whatever. We can talk about Boston, et cetera. So that's one area. And then two is what we call sports adjacent. So if you take the teams in the leagues and put them in the center, and then it's all these businesses that have been set up around them, around that content to monetize that content or engage with that content. And so think ticketing, gambling, data analytics, sports agents, apparel companies. There's a lot of med tech interesting stuff which is going out there trying to optimize sports performance, et cetera. So there are a whole bunch of businesses in that sports adjacent ecosystem. They tend to be more traditional businesses, right? They're startups, they need equity, they need debt. They buy companies, they sell, some of them go public. We led the StubHub IPO last week, which is definitely in that sports adjacent space. And so I think that bucket's a little bit more kind of traditional investment banking in terms of what we do across all the other industry verticals at Goldman. And the third bucket is infrastructure. So think stadiums, arenas. My co-head of the business, Greg Carey, has been doing this for 30 plus years and has financed 50 plus buildings on a global basis. And what's really interesting about the infrastructure vertical is you used to be able to, for a couple $100 million, buy an arena, maybe the city put in some money, the owner could put in some money. These things are big, massive, multi-billion-dollar projects now. They tend not to pencil out in terms of just the sports team playing and having fans come into the building. And so what you're seeing now is you really almost need to build a city. So you need mixed-use development, you need entertainment zones, restaurants, concert venues, apartments, et cetera, to do this. And there's a lot of capital that's interested in that. And so as we think about these three different buckets, they're all fundamentally sports-related, driven by sports. But for the 12, 15 institutional capital private equity firms that are focused across the sports vertical, the cost of capital, how you think about investment, how you think about returns, how you think about timeline in terms of exit is fundamentally just very, very different across all of those. And so that's how we think about the business. I'd say, our business and what we're seeing, there's enormous activity across all three of those verticals. But Josh, I'd be curious for your perspective in terms of where you think, of those verticals, what do you think is the best opportunity or where are you seeing the most velocity?
Yeah, I think there's opportunity across all three of them, and it would depend a bit regionally on what you're talking about. We've obviously seen a lot of velocity around team stake sales, selling pieces in the U.S. And I think we're going to enter a cycle of a lot of infrastructure development being done around sports in Europe. They're driven by different factors in the broader economy, right? Without sort of trying to go down a rabbit hole on this, the infrastructure development and that building a city that Dave talks about, which I think is such a great phrase, because that is what's happening now. If you look at something like SoFi, a building that our portfolio company Legends manages, where the Rams and the Chargers play in LA, like that was
Olympic swimming. That'll be very, very cool.
It will be. It will be. But that was a call it $5-6 billion project, and the idea was to really change the neighborhood of Inglewood in LA, and what I kind of love about sports, I love a lot of things about sports, but what I'm loving in the moment about the business is that you are seeing at once a massive impact and differentiation of this industry on a global level, right? So take Champions League soccer, Premier League soccer, and I think increasingly basketball will try to do this. This is a global product. The number of people who watch the World Cup or who watch a Champions League final, there is really, in a world where we are increasingly siloed, in all kinds of ways, there are very few things that can convene the planet around that. And global football does that. The Super Bowl convenes us as a nation in a way nothing else does. This is sort of cuts through all distinctions among people, which I think is a very rare and really important thing right now. So you can't get any more global than that. And then you've got these hyper-local transformations, like the neighborhood around SoFi, right? Where the Kroenke family put billions of dollars in just transforming a neighborhood. And I think we've seen that in Atlanta, your hometown, with the Battery. And I think we will continue to see that tent poling of neighborhood transformations. And no surprise, it's often going in neighborhoods that need that capital the most, because that's where these guys can get the land. So like that combination of hyperlocal and hyperglobal is really interesting to me. And I think that we're going to see a lot of opportunity in both of those verticals, but driven by different conditions, because the financing conditions and the things that Greg and Stacy do to provide capital to, put that all the way through the very esoteric financing structures that get done around a stadium. We need sort of a well-functioning financial system to make that attractive in a way that doesn't really impact global media rights. So I think that's really exciting, and I think the role that technology will play in this is going to be really interesting, because we have this massively hyperglobal, hyperlocal, and when does technology really bring a level of personalization around the consumption of sport that's like going to affect something in the middle? But we have, those of us who like sports, we have passion, and that passion will continue to be a very important engine for businesses to draw attention, which, as we all know, we're in an attention economy, and that can be where you spend your Sunday, whether you go out to, Truist and, watch a ball game, or whether you choose to buy ESPN Plus in its latest configuration.
That's very helpful. Barcelona is a great example. I mean, we've been working with Barcelona. We've been working with you on Barcelona, but they're in essence, we've helped them raise over $1 billion of capital to completely gut renovate Camp Nou. And we're seeing a lot of this across Europe. There's just a lot of dated infrastructure. Many of you have gone to recent arenas or stadiums in the US, right? There are 20 different ways to get in. There's suites, there's decks, there's price points, there's experiences. That really hasn't happened yet in Europe, and so we're going to see this certainly at the Premier League level and the top soccer club level. Billions and billions of dollars going into the infrastructure there to really renovate and gut. They're building a museum to Barcelona, which when all of you go on your post-grad trips to Barcelona, you'll stop by and go in and spend some time. It's really, really interesting in terms of what's going on there. Let's maybe pivot and talk about another area where we've had the opportunity to work together. So Celtics, right? Good example. Bill Chisholm, Wharton undergrad, or sorry, I don't believe
he was grad. He was Wharton grad.
He was Wharton grad.
Dartmouth undergrad.
Dartmouth, that's right.
We don't like to say
Dartmouth,
that word.
Dartmouth undergrad, that's Dartmouth right. Boston guy, built a private equity firm. Any kid's dream, the opportunity to go bid, win, own, control, and be the governor of your hometown team. So we had the opportunity to work with Bill Chisholm as he worked on that bid for the Boston Celtics, works very closely with Sixth Street. So maybe why don't you talk a little bit about the role Sixth Street played in that, and we can talk about just how, from an advisor perspective, a principal perspective, we interrelate and have the opportunities to work together.
Yeah, and we had our first board meeting yesterday in Boston for the new ownership group, which was pretty great, and a tribute to a lot of the great work that you guys did to get us all there as investors. So with what I can say about that process, for a public audience, I mean, the Grousbeck family were amazing stewards of the Celtics, and you think like Wick coming in for $300 million not that long ago, turning into a $6 to $7 billion asset, and along the way, winning 2 championships, going to 4 finals, making the playoffs 22 out of 24 years, I think. I mean, what an enormous legacy. It's going to be really interesting to see what Bill brings to this, because he is a technologist. The firm that he built was around technology. And sitting in the board meeting yesterday, going through what the data and analytics people do. By the way, I love the name Wasabi. I don't know who came up with that, but that's good. I think if we talked to that person at the time Sixth Street was named, it might have been named something different. But the idea of bringing analytics and the next level of analytics, and how is that impacted by AI? I'm sure what a lot of you guys are thinking about when you think about your careers is like, what is AI how's that going to impact the world that you live in? And I think as much as that's scary, it's a massive opportunity. And you think about a franchise like the Celtics, who in their own minds, and I think in the minds of many of us who are fans, stand for a commitment to excellence. I think technology is going to play an increasing role of that. And I think the role that we played in the structure was, as you know, was sort of helping develop financial technology along with them, along with Bill. And it's a rare and special opportunity to have somebody who's as sophisticated around this as Bill was, and great advisors like Goldman that allowed us to create, do a bunch of things that had never been done before on a bunch of sides. And I think like if Bill were here, he would talk about the fact that, a model where effectively you coalesce a group rather than the historical way these bids have been done is you had these silos of people. So if you need $6 billion for a franchise and you want 3 people competing, you really need to go find $18 billion. Like when we were growing up, the idea that a franchise would be worth $1 billion would have been staggering. And now you can barely find a franchise in the Big Four that's not. And that's a really different world in terms of what it takes to buy and own this. And if you're going to be someone who wants to own one, you're not going to do it the way it used to be done. And that's going to involve new structures in terms of how these assets are bought and sold, which Goldman was really helpful in. And it's also going to involve new ways of financing them. And that's really caused the role of firms like Sixth Street to come in to directly investing in clubs in a way that was never possible before. And I think we're going to see more of that because the need for capital in the market is just going to continue to grow. All these things we're talking about, building these buildings, going global, it's going to take a lot of money. It is a capital-intensive industry.
Just to refresh, and some of you may be aware of this, but it's really a recent phenomenon in the North American leagues, really over the last 5 years or so, that the NBA, Major League Baseball, and then the NFL just literally about 12 months or so ago opened up to institutional capital. And so if you want to go buy an NBA team, each of the leagues have rules that are different, but they're directionally similar. So in the NBA, to be the control owner, you have to put up 15% of the capital, right? So you have to be at that 15% level. In the NBA, it's 30%. In the NBA, they've opened up and said you can have 30% institutional capital. So what Sixth Street or other firms are able to do can provide up to 30% of that capital. Actually, I think it's 30% institutional. Any individual firm's capped at 20%, but in essence. And so as you think about, if you're the NBA, if you're league owners, you think about the capital needs, the ability to invest in the business, all the technology investment. We should come back and talk about direct-to-consumer and what that can mean for some of these big global brands around the world. But so that just opened up enormous amounts of capital because, to Josh's point, there just aren't that many people on the planet who can write $4, $5, $6, $10 billion checks. Some have an interest in teams, some don't. When Steve Ballmer bought the Clippers several years ago at $2 billion, I think people just literally fell out of their chairs saying, gosh, how could you possibly be paying that much? And that looks like a steal today.
Well, to plug us, when we did the Celtics deal, at $6 to $7 billion, everybody was like, these guys have lost their minds. And it was weeks until the Lakers traded at $10 billion. Yep. And so I think the direction of travel is clearly upward on those franchises.
We completely agree with that premise, and I think it's interesting. You have the two, certainly two of the top 3 or 4, but the 2 most successful franchises in terms of winning championships, just iconic names, trading basically over the course of the year in the NBA. And I think part of this trend is this size, the opportunity set, that these have become real businesses. They need real capital investment, and you need really, really deep pockets. And the NBA, the NFL, Major League Baseball, National Hockey League, have understood this, and that's why they moved in this direction over the last 4 or 5 years to open it up. But I agree with you that over the course of time, I think there'll more outside capital, institutional capital will be permitted. I think there'll be more creative structures. And if you really think about what it is, it's helping drive down the overall cost of capital of investing in a team. Because if you look, the NBA's restriction, basically $500 million of debt. And so $500 million of debt on a $5, $7, $8, $10 billion enterprise on a loan-to-value basis, that's relatively light across any industry. But I don't believe they or the other leagues are going to allow you to put a ton of debt on inside the box.
No, I don't see that happening.
But all these creative structures which Sixth Street is innovating on along with others, allows you to really be much more creative outside the box in terms of how you finance that, how you capitalize it, how you drive down the cost of capital. And for all of you who are Wharton students, right, driving down the cost of capital is just enormously helpful in terms of helping support and drive up higher asset values. So there's a lot of, it's really interesting in terms of what's going on.
Should we take some Q&A? Oh, great. Okay, they're not going to let us take Q&A yet. It's coming, so you guys should be thinking of questions.
You touched on Europe. Just how do you think about Europe, or how do you think about Asia and the ability to deploy capital? And North America is very distinct from a sports league perspective. The top 4 leagues have really strong governance. They have commissioners. They have decision-making processes that are in place, which, quite frankly, has been enormously helpful to driving the asset value, because investors know what they're actually investing in, and you can actually understand the business model. Most of Europe, most of Asia, most of the other leagues, it's a little more ambiguous in terms of what that governance structure looks like. But how are you guys thinking about Europe and Asia?
Yeah, I mean, I think the very differently from each other. So I wouldn't lump Europe and Asia together. Asia is, I think, selectively very interesting for sports assets. I mean, when you look at what the India Premier League of cricket has done, they have created the closest thing to the NFL, to sort of an NFL-like structure that we've seen, but with a obviously much more global audience. You know, not that same level of monetization, but you know, it's hard to find a much better business on the planet than the NFL, and the IPL in sort of the growth category is pretty interesting. But you're exposed to a lot of macro volatility in those local markets. You know, we sort of think about what things like tariffs mean for us, but you know what the impact of that is in markets that really rely on exports is really significant. And I think that does create volatility that makes it a little harder. You got to be a little more selective in Asia, before you even think about things like, you know, currency fluctuations, which are tied into those same factors. Europe's right.
I'd say I mean, just on the IPL, I mean, just to level set, right? We talk about the NFL, 125, 150 million people watching the Super Bowl, $8 million for a 30-second spot, right? In India, the IPL, 300 million people watch that a week, right? So if you buy into this India growth narrative, massive growth in the middle class, gosh, you can do some simple math on that and get pretty excited about where those valuations right, can go. But there's a lot of volatility. You know, there's certainly a lot of volatility to it.
It's true. Although I remember, like, I don't know, 10 years ago, 15 years ago, when we were all pretty excited about Brazil, and I was doing a deal down in Brazil, and someone, some lawyer just said to me, "Yeah, Brazil, it's the country of the future, and it always will be." Yeah, you know. And I think that that's a bit, you know, like there's a investors have this phrase, you know, being early is the same as being wrong. And I think the one thing you got to watch out for with India, particularly in a period of geopolitical volatility, is I think it's there. And I think we would love to be invested in a place like the IPL as part of a portfolio. But that is also something where, you know, fund structures like a private equity or private capital fund, you know, one thing they do that's really important is they spread risk. And I think I like the IPL as part of a portfolio. If the IPL was the only thing I owned, I'd be a little nervous. I'd probably outperform, but I'd have a lot of sleepless nights. Europe, on the other hand, I think is really compelling, and we've seen a really surprising, very like Northern Europe and Southern Europe have gone different directions, and over our life, you know, you would have always said, of course they do, because Northern Europe's always going to outperform and Southern Europe's always going to lag, and that's flipped. And I think that has some really interesting ramifications in global sport when you think about how strong a sport like European football is in, you know, a place like Italy or a place like Spain. And I think we're going to see a lot of infrastructure dollars go into those places in a pretty interesting way. And I think we're going to see franchise values be strong. And make no mistake, the EPL is probably, in terms of consequence, the EPL is probably the most consequential regular way league on a global basis. And I think we'll continue to see strong investment in the EPL. That's actually, I think that's risen beyond UK-specific considerations at this point, what the value of those assets do. I think they are the most global assets probably that we have, other than like a handful of global football clubs like Real Madrid and Barcelona. We're invested in both of those. And Dave and Goldman have been involved in those opportunities as well. If you can have a global brand, so we say, what do you think, Europe and Asia? What I would really like is truly global. Yep. And it'll be interesting to see what the NBA does in this respect, because it has the potential to be our really global league. Will the NFL get there over time? I would never bet against the NFL to do anything. But the NBA is kind of there now. And basketball is a sort of number 2 or number 3 sport in a lot of places. And the NBA is good at marketing and brand building. And I think we'll see them do some consequential things. And I think you'll see a lot of investment capital attracted to that.
Sixth Street, you've been instrumental in terms of investing in women's sports. Maybe spend 2 minutes just talking about view on women's sports, which is certainly having an incredible growth moment and an enormous amount of capital flying at it.
Yeah. No, and I think what's interesting, people don't realize the fastest growing segment of the WNBA audience right now is men, right? And I think when we first before we invested in women's sports, we saw the media consumption around women's sports tick up, and that's always a leading indicator, right? I mean, you look for leading indicators. What are the things that are non-economic directly now that are going to translate to economic success of an enterprise? And in sports, if you see somebody's media, if you see audience growing, and some of that was obviously Caitlin Clark, but it's a broader phenomenon now. And the WNBA has been leading the way. What we felt was the most attractive sort of risk return in there was the NWSL, because we don't yet have the best men's soccer in the world. And hard to say that, but I think we're a little ways off. We do have arguably the best women's soccer in the world. And the NWSL represents a globally interesting brand in a new way. So we're seeing around the world, numbers in the UK are growing faster than they're growing here. We're seeing global interest in that. So getting behind that in an early stage, we talked about sort of the value of a portfolio. When we invest in the Celtics or the Patriots, or the Spurs or the San Francisco Giants or FC Barcelona, Real Madrid, those are mature enterprises. They're growing really well, but they're fully scaled. We all know what those are. Not that many people in this room may know what Bay FC is, and so which is the NWSL team we own in the Bay Area. And so the opportunity to add to our portfolio something that has that kind of growth potential, but operating in a market like the U.S. where you can be highly confident of the underpinnings of the market, not some of the India, Brazil volatility we were talking before. That's a very attractive opportunity and very sort of capital efficient for us.
Terrific. Cindy, should we pivot and take some questions?
Yes. Everybody, we are going to do 15 minutes of Q&A. So if you have a question, please feel free to raise your hand and I will come by with the microphone. Okay. Someone very quickly up there.
Thank you for the lecture. I would like to ask about the cyber sport. Do you see any opportunities in the cyber sport? Is it active for you? Do you think about it like an asset in your portfolio? Thank you very much.
From me or you? We
Portfolio.
Portfolio. All right, that's me.
We're not spending a lot of time there from an advisor perspective.
I actually think it's a really interesting question because let's take motorsports, right? 2,000 years ago, we were watching, watching sort of horses run around in a coliseum was, where sports were, and obviously the horse racing is still interesting to a bunch of people. But at some point, cars came in, and people figured out how to race cars, and that became a pretty interesting global business. It's an interesting question when cars can race themselves faster than human beings do. Do we find that interesting, or do we like the human drama of human beings competing against each other? I don't think we know, and in my investment lens, there's nothing kind of mature enough yet around a true sort of cyber sport. But you can see things like Drone Racing League, which is out there and doing some interesting things, and I don't think is entirely caught on with a mainstream audience. But I would be really surprised if someone didn't figure that out. I mean, I know, like San Francisco, they've got like robot fights now, where like people are, that's like I think we should pay attention to that, because I think that there's going to be something developing there. And if I were at your guys' point in the career, like that's something to watch, I think, and pay attention to. Kind of in my advanced years, it's probably going to be a little less relevant, just given the horizon to build. But I think it's an area worth spending, paying attention to, and the ancillary technology that's developed as a result of that, and the development of technology elsewhere to feed that will, I think, be a really interesting flywheel. I don't know.
Yeah, I think ultimately you have to aggregate audience, right? And so, like the drama around sports, and we've seen this, and it's spiked dramatically coming out of COVID. Any type of live entertainment, it's people are looking for it, and the ability to aggregate audience. Advertisers are looking to get access to that, and so whether it's media rights, sponsorship, anything is critically important to be able to drive that audience. And so I think that's the lens you got to look, in essence, look through it. You can go ahead and just shout it out, and we'll repeat it if people can't hear it, just to be efficient.
That's true. We talked a lot about like global soccer and that being an interesting opportunity, but I think one of the key dynamics that's different is that in the U.S. you obviously have these like closed sporting infrastructures where if you're an NFL team, you'll always be an NFL team. When you look at Europe, you have promotion and relegation. You also have competition of leagues across Italy, Spain, England. I think 20 years ago you probably would have said Italy was the best league in the world. Now it's DPL. And so as you look about or thinking about investing in those areas, I'm curious, like how you think about those dynamics and how that affects valuations.
Yeah.
Well, can we go? Or go ahead.
You go first, then I'll go.
Yeah, like I'd say, it absolutely does, right? I mean, you look at the value of the EPL teams, right, relative to where the NBA is or the NFL is. A lot of it is that relegation, and a lot of it is that open, broader market, which has more potential for disintermediation or competition. So I think it's absolutely a critical factor. I think what you're also seeing, which we haven't touched on too much, but I think as you think about these brands, there's probably, 20, 25 brands that are probably truly global brands. And so you think about direct-to-consumer and what best-in-class direct-to-consumer marketing looks like. And we're just at the beginning of this. Teams are just at the beginning of this. But we've worked with European football teams that have 100 million people in their database, and they're not doing a good job. They would self-proclaim they're not doing a good job in terms of monetizing that. I don't know how big the Celtics database is today, or you think about the Lakers, or you think about the Dodgers or the Yankees, right? There are brands that will transcend. They used to be local, then regional, then national. They're a handful. But you think about these brands, they're truly global brands. And so you think about the value proposition of having 100 million people in a database in a sport that is multi-generational, incredibly sticky, passionate, tends to skew. People spend a lot of their disposable income, right, on the sport, on the brand, et cetera. And so you think about brands wanting to be associated with this. You look at what's happened with Formula One and the branding that's gone along with those teams, which 5 years ago people thought, gosh, are these teams even kind of viable? And now today they're big, viable, massive businesses with multi-billion-dollar valuations. But I think you're going to see this. I think it's part of the valuation that you're seeing on certain teams in the NBA. I think it's part of the NFL, and it's certainly part of how to think about valuation for some of these big global, kind of European brands. So it absolutely is. But I think we're going to start to see in a software context, I don't know if you had 100 million people, right? 1% was in bucket 1 and bucket 2, 3, 4, 5. If you could just take 50 basis points of those fans from 2 to 1 and 3 to 2 and 4 to 3, I mean, you could grow for 50, 75, 100 years. And these are durable brands, right? These are multi-generational brands. And so I think teams are just at the forefront of starting to get going on this, which I think is really driving valuation. I think you're going to see that. That's part of what's driving some of these differential values, even across leagues, in terms of how people think about valuation.
Yeah. And I said, my son's here, and he's on the Penn soccer team, and when I offer any opinions about soccer, I run the risk of being, derided. So I can't respond to was Italy the best league versus others? It isn't now the EPL, but I will say that money matters, and if the EPL is the best league out there, it's because they've figured out how to get more dollars out of the ecosystem. And part of that, to your question on promotion relegation, is creating drama and narrative. And what's so remarkable about what the US leagues do is in a closed league, they create an enormous amount of drama and narrative. And I think promotion relegation today actually could be seen as creating less drama in leagues where you have really lopsided outcomes. I mean, the French, and again, not getting over my skis and offering an opinion about the substance of soccer, I will say that the French league hasn't been interesting for a decade or more. And everybody knows who's going to win that league. And so I think you need to create drama, and how you do that's important. But in my view, thinking about European sports and comparing them to the NFL or the NBA or Major League Baseball is a mistake. College sports is what European sports are, right? We've seen conference realignment. We see conferences competing against each other. We see sort of a pan-conference playoff that brings interesting people together in different ways. And so when I look at European football, it feels more like college football in the US. We have seen an enormous amount of change around college athletics, and I think there's still more change to come. And I think we will see change around European football to some extent, because it's both the strength, it's a strength that it's so dynamic, and you don't have these very strong league models that are, unbreakable. But I think we'll also, there'll be volatility associated with that, which, look, for an investor, volatility is the opportunity. I mean, if everything is obvious to everybody and you know exactly how it's going to play out, then everybody can price it and act on it in exactly the same way. So Europe to me is very interesting because there are bets to be made there.
You talked a little bit about Brazil always being the country of the future and kind of how Latin American sports play.
Yeah.
I think the ecosystem in Latin America for sports is huge, but it still lags very much behind. It still doesn't attract that much attention from investors, particularly in the US. How do you see that playing out throughout the next years, and how do you see the space for them to evolve and actually capture that money from the US?
Yeah. You may want to weigh in on this one too, but what I would sort of say is the lesson of Latin American sports is, macro matters, right? And if you don't have a stable currency regime, if you don't have a stable, relatively stable government and legal system, it's hard to build, it's hard to attract the capital that provides the necessary capital investment to create the infrastructure around this. And on one level, you put this content out there and people around the world consume it. On the other level, in sports, infrastructure and capital investment creates the demand. You can't have 62,000 people in a European football stadium until you build a stadium that can hold 62,000 people. And you have to invest those dollars. And if you can't attract global capital, you're just going to have a hard time. The passion is there. The middle class to pay for it is there. Certainly, the quality of athleticism and the quality, just to take global football, amazing. But, Latin America will continue to export its best players and lose its best competitive assets until it can really create an economic system that can support them in the region.
We got about 4 minutes left. We'll try to do this rapid fire. Take as many as we can. Go ahead. We'll try to be short.
You talked about sports as an asset class, and I'm just curious from a portfolio construction perspective, what role does it really play in the portfolio, particularly for someone who's not viewing this as like a vanity asset or a passion project?
Yeah, look, I think if you go back over the last 30 years, right, the unlevered returns have kind of been in that low double digit to mid-teens, depending on how you look at it. By the way, if you look at the S&P over that period of time, it's been pretty close to that as well. So I think what's different, these are long-dated assets, right? You're 50, 100-year type assets. And so there's definitely an element to it, but I'd say it's really, really early in terms of, I think, big macro portfolio managers saying, I need to get exposure to this. And I think the number one thing, certainly as it pertains to the teams, is what does secondary liquidity markets look like? We're spending a lot of time on that because it's easy to get in and you're seeing a lot of capital come in. But if you're an institutional capital allocator, the number one thing you need to be aware of, and everybody learns this the hard way in the financial crisis and COVID and other situations, you really need liquidity. And so what does that secondary liquidity look like? And the secondary liquidity markets are choppy, very, very choppy at best. I think over time it'll develop more akin to where the private equity markets have gone over the last 20, 25 years, where there's secondary market with liquidity around it. But I think it's the governance, the restrictions on ownership, approval rights, et cetera. There's a lot of stuff that needs to get fixed from that perspective. So I think it's very early.
In the middle, back there.
Josh, you mentioned the power of sports to bring people together. That's my favorite thing about sports too. Especially thinking about the NFL, there's like thousands of people that are going to hug this weekend that agree about nothing else.
Yeah.
And so my thought is kind of, what do you think the role of kind of these big franchises are to help support the democratic and social institutions that help them kind of have the foundation to grow that?
I think it's exactly what you said. I think if people focus on what they have in common, that supports democracy intrinsically, because democracy is what we have in common. I mean, if we're engaged in the common governance of a society, like, we have that in common. And if we also can find other common ground that we agree on, and even though we agree on nothing else, we can hug each other for something. I think you've answered your own question. Yeah. Do you want to do one more?
Yeah.
On the edge, right there.
Yeah. So you got the Celtics going for like $6-7 billion, the Patriots for 10, give or take. How do you think about like underwriting that at this point? Because it feels like to get like a solid exit for 6th Street, you need like a $30-40 billion exit. And at that point, like, you're starting to price out some of the big institutions outside of like Saudi PIF or something like that. So how do you guys think about underwriting and like thinking about the exit when teams are growing that large in valuation?
Yeah, I mean, if the team doubles the size, so this is like a little basic corporate finance, right? There are two ways you can make money on an investment. Either the multiple that you're selling it on expands, or the P&L, the revenue or EBITDA of the business that you're acquiring and hoping to sell expands. I think if you look to Dave's comment, if you look at sort of the level of growth, just how quickly are these guys growing revenue? What's the next media rights deal going for? You're seeing these things grow 8 to 10% fundamentally. All you guys who are in Wharton should know the rule of 72, right? If something's growing at 10% a year, it's going to double in 7.2 years, right? So if I aspire to double my money, I just need that thing to grow at 10% for 7 years, and that does my work for me. I don't need to do more than that. So I think that one of the things I learned early is invest around growth, because everything's easier when you're around growth. And these assets are growing and they have persistent tailwinds to grow. And I think that that's going to create positive outcomes. In terms of your comment, like, well, who's got a big enough checkbook to go buy those on the other side? I'd refer you to Dave's excellent answer on secondary liquidity, because that's what happens, is ultimately you create liquid markets. Because PIF is very big. It's very small compared to, for example, the aggregate value of all publicly traded securities on the planet, right? So there's plenty of money to buy things in the world. It's just not necessarily going to be one single investor. And that's what I think, to bring us back a little bit, what we all did together around the Celtics is relevant, because that was really coalescing, coalition-based buying for this. And I think we're going to see more of that, where you don't need to rely on, is Jeff Bezos going to buy this franchise or not, and that's going to have a big impact, or Saudi PIF can't invest in U.S. franchises, directly, but whoever would be the stand-in for that.
The only thing I'd add too is just, right, there's been forever in time, sports franchises have not made money. There's been no cash flow. And what you're seeing in the NFL now, every NFL team now is profitable, right, with the new media rights deal. And you basically have a unique structure when you have the hard cap, right? So every incremental dollar is margin enhancing from an NFL perspective. And so the NFL, the NBA with their new media rights deal is getting to this point where there's real cash flow through cycles in these franchises. Now, a lot of that will get reinvested, to Josh's point, because there's so much growth opportunity. But these are businesses with real profitability in these leagues that are durable and all the things which we talked about. And so we are now, I think if you look at the NFL, I don't know if you agree with this, but right, you can actually now put a EBITDA multiple, free cash flow type multiple around most of these teams. They're high. They're kind of big multiples, probably 50 to 100 times, but they're actual real multiples as opposed to just this kind of revenue swag. And you think about the durability of that revenue stream, you think about the profitability and the cash flow, and you think about this direct-to-consumer opportunity. You can do real valuation work now around many of these teams, which 5 years ago you really couldn't.
Yeah, I'd agree. And by the way, 2 years, that's really been the last year or two that we've seen people start to take that approach.
Yeah. Well, Josh, thank you. This has been a lot of fun.
Thank you, Dave.
Enjoyed it.
Good to see you, man.
Cindy, thank you.